Okay, so you're a high income earner, you have a W 2 job, or maybe you're running a business, and every year you're paying a substantial amount of money in taxes, so much money that it hurts every single time you have to look at your tax return. And you heard that by investing in real estate and using the real estate professional status, also known as REPS, or by investing in short term rental properties can help you significantly reduce your tax bills. And you're curious to know, how does it work? How do I qualify? And which one's for me? Well, that's exactly what we're going to cover in this video. Hi, my name is Castelli, and I've helped hundreds of high income earners use the real estate professional status, the short-term rentals, and much more to reduce their tax bills significantly. I look forward to helping you figure out which one's for you in this video. So without further ado, let's go ahead and talk about it. All right, so before we dive right into the real estate professional status and short-term rental investing, it's really important that we have a foundational understanding of why we're going to even use these tools to begin with. So when you invest in a rental property, whether it's a long-term, mid-term, or short-term rental, you're typically going to have rental income, right? Hopefully you're renting it out to somebody and you're generating some income. That's what we all hope. So you're going to have your rental income, then you're going to have your operating expenses. You're going to have things like utilities, property taxes, repairs, maintenance, professional fees, landscaping, all of that good stuff that it takes to actually keep your property in running order. Those are going to be hard expenses. And what I mean by that is these expenses that you actually have to pay somebody else. So the money's going to leave your bank account. Now, in most businesses, you're going to have your income, you're going to have your expenses, and that's going to leave you with net profits. Just going to keep things simple here for the purpose of this video. For any of our accountants out there watching, we're going to have your net profit. And normally you're going to pay taxes on your net profit, usually up to 37%. In federal taxes plus state taxes, and in many cases you have FICA or self-employment taxes, which can be substantial. However, with real estate, there's a special expense called depreciation, which really only exists on paper and has the power to create a loss for tax purposes. So in other words, you're telling the IRS that you lost money. Meanwhile, your property is probably appreciating and you're generating positive cash flow. What could be better than that? That is like one of the major tax benefits of investing in any type of real estate, is the ability to shelter your cash flow from taxes. However, the next question is, what happens to this rental loss? Okay, now this rental loss can often be substantial if you're using bonus depreciation, which we'll cover in another video. But for right now, all you have to know is that you may have a sizable loss from your rental property, maybe $20,000, $30,000, $40,000, $50,000, or frankly, in some cases, even much more than that. And you want to be able to use this loss, this $20K to $50K loss in this example, to offset your W-2 or your active business income. So you're reducing the amount of taxes you're paying on those sources. But the problem is, all rental activities are passive by default. And what that means is that these losses can only offset other passive income, which is typically rental income or capital gains from the sale of other passive activities, again, most likely your rental properties. So how do you get these losses, these non-cash losses, to offset your W-2 or your business income? Well, that's where the real estate professional status and short-term rentals come into play. All right, so the first one we're gonna cover here is the real estate professional status, also known as REPS. And what the real estate professional status allows you to do is it allows you to take the losses from your long-term and your mid-term rental properties and use them to offset your W-2 and your active business income, which again is going to help you substantially reduce your tax bills. So the real estate professional status, just keep in mind here that it was originally put into place to allow full-time real estate investors to take the losses from their properties and offset their other income from their other real estate businesses. And as you could tell by the requirements, this is the purpose. Now, to qualify, you spend more than 750 hours and more than half your total working time in a real property trader business. There's 11 real property trades for businesses. We're not going to cover them all here in this video. If you're watching this, the one you need to know most about is going to be rental activities, right? So your rental properties are one of the 11 real property trades or businesses. So here's some of the challenges with the real estate professional status, all right, if you're a high income earner. First thing is that you have to spend more than 50%, okay, of your total working time in a real property trader business. And if you have a full-time W-2 job or you're running a business full-time that's not a real property trader business, this is going to be very challenging, if not frankly flat out impossible to do, as proven by IRS and tax court cases. And this is because the IRS considers a full-time job to be 2,000 hours per year. Okay, so that's roughly 40 hours per week, assuming you take 2 weeks vacation. And in order to spend more than 50% of your total working time in a real property trader business or your rental activities, you need to spend more than 2,001 hours on top of that. So that means you're working 81 hours per week for the entire year. And frankly, the IRS and tax courts know that's really not possible. And it's really only one person's ever actually made it through that. So that's the first issue with the real estate professional status, is you do need to spend more than 50% of your total working time. The second challenge with the real estate professional status is that rental activities, long-term and mid-term rentals, tend to be relatively passive. Once you get them set up and once you have a tenant in place, you really don't need to spend much time managing these properties, okay? And that makes it challenging to get to 750 hours. So in order to do that, you typically need to have several properties. And yes, you can do it with as little as one if there's significant rehab work, or it takes a significant amount of time to operate, maybe of a larger property, commercial or multifamily property that takes a lot of your time and effort to manage. It is possible to qualify with just one. But again, the issue is 750 hours is a lot of hours to spend. So usually you're gonna need multiple properties to qualify, all right? However, here's some pro tips that can help you qualify for the real estate professional status. The first one is that maybe you're a high income earner, but your spouse, maybe they work part-time or they don't work at all, and they can take over the responsibilities of your rental portfolio, and they can reach the 750 hour and more than half their total working time requirement. Now, if you file a joint return, so married filing joint, or MFJ for all of our tax nerds out there, if you file a joint return, then the losses from your rental properties, because one spouse qualifies, can benefit the other spouse by offsetting their high income earner. So again, to summarize this right here, so you have spouse A, high income earner, spouse B, they're a real estate professional. You file a joint return. Now you both effectively qualify, and the losses from your rental properties can offset your high income. So that's one of the ways to qualify for the real estate professional status, and in fact, how many couples actually get this done. But the issue is, what happens if maybe both spouses, what if you're single, right? What if you're single, you're not married, or you're in a two-income household where both you and your spouse are working full-time. But what happens in a situation when you're single, or that you are in a two-income household where both you and your spouse are working full-time and neither of you can qualify for the real estate professional status? Because again, this is not an easy thing to qualify for. Well, in that case, that's where short-term rentals might just be the answer that you're looking for. Now, if you do have any questions about the real estate professional status before we dive into short-term rentals, go ahead and drop a comment and I'll personally get back to you with an answer. And if you have any questions about short-term rentals as I go through that section, drop a comment too, and again, I'll personally get back to you with an answer. Okay, moving on to short-term rental properties. Okay, so short-term rentals are a little bit different from long-term and mid-term rental properties, and that's because they're treated much more like a business. And because they're treated like a business, they are not passive by default like other rental properties, which means you do not need to qualify for the real estate professional status in order to take the losses from your short-term rentals against your W-2 or your active business income. But here's what you do need to do. Your rental property needs to have either an average period of customer use, or guest stay as some people would say, of 7 days or less on average for the year. Okay, it's an average, not 7 days or less, but on average for the year. Or you need to have 30 days or less, an average stay of 30 days or less, and you're providing substantial services, which are hotel-like services that you would normally find in a hotel, such as daily cleaning, daily meals, concierge, things of that nature. Now, these rules were originally put in place for hotels, motels, and similar establishments in the 1980s. However, they can apply to your Airbnb or your VRBO, short-term rental or vacation property today in today's world. Okay, so that's the first step, 7 days or less on average, or 30 days or less, and you're providing these hotel-like services. Once you do that, you're moving from the rental bucket, which is passive. Remember, it's passive, rentals are passive. You're moving into the business bucket. Now, the second thing you need to do is you do need to materially participate, which basically means self-managing your rental properties. The same goes for the real estate professional status. In either case, you are going to have to self-manage your properties, okay? But here, you don't need to spend more than 750 hours and more than half your total working time. All you need to do is you need to meet one of the following tests. The first test is you spend more than 500 hours on your rental properties, okay, or your short-term rental. Okay, the second one is you're going to do substantially all of the work yourself, meaning you're a one-person show and you have very little to no outside help. Or the third one, and by far the most popular test for short-term rental owners, is you spend more than 100 hours and no one else spends more time than you. Okay, and this is by far the most popular one because it allows you to handle all of the guest communications, initial setup of the property, and some of the ongoing things that need to happen as you're going along your short-term rental journey. But you're able to delegate to cleaners and repair folks who can take care of those details while you are able to just run the show. Okay, that's why it's the most popular test. Now, here's some additional benefits of the short-term rental strategy here, of investing in short-term rentals. So with the real estate professional status, and I forgot to mention this before, so sorry about that, but I'm going to mention it now. That 750 hour and more than half your total working time test, if you're married, one spouse has to meet that by themselves. However, when it comes to materially participating with one of these 3 tests I mentioned, both you and your spouse, if you are married, count as one person, right? So if you're using the 100-hour test, 100 hours, and no one else is spending more time than you, it's you and your spouse combined as one person. You spend more than 100 hours, and no one else besides you and your spouse are spending more. Okay, so that is something you can work as a team to get done. And as you can already see with short-term rentals, the requirements, the hourly requirements, are a little bit less intense, right? You don't need to spend 750 hours and more than half your total work time. All you really need to do is spend more than 100 hours and more time than anybody else, okay? Much lower bar. Now, here's the interesting thing though with short-term rentals. It is a more operationally intensive business in almost all cases because you're going to have people coming and going more often, which means more guest communication, more marketing and advertising, more time spent on price optimization, and then also you're going to have to coordinate cleaners and repair folks to come and fix the property and make sure it's in tip-top shape. All right, so that is the downside, I guess you can say, of investing in short-term rentals. It is versus long-term rentals. It is a little bit more operationally intensive. However, by investing in short-term rentals, you can use this strategy to offset your W-2 or your active business income in a much easier way than the real estate professional status. So those are the 2 strategies, the real estate professional status versus the short-term rental loophole. Let's give a quick summary right here. The real estate professional status allows you to take the losses from your long-term and your mid-term rentals and use it to offset your W-2, business, and other non-passive income or other active income that you might be generating. However, you do need to spend more than 750 hours and more than 50% of your total working time to qualify. And if you have a full-time W-2 job or you're running a full-time business, very challenging, if not impossible, to qualify. So in that case, if you or your spouse cannot meet those requirements, the other option you have is the short-term rental investing, right? So you invest in a short-term rental and you rent it out for an average period of customer use of 7 days or less, which is by far the more popular exception. And you materially participate, usually by spending more than 100 hours and with no one else spending more time than you. You do those 2 things and your short-term rental losses can help you offset your W-2 or your non-passive income. All right, so there you have it. 2 of the most powerful ways that you can use real estate to reduce your taxes on your W-2 or your active business income, the real estate professional status and the short-term rental strategy. So if you have any questions about either of them, go ahead and drop me a comment. I'll get back to you with an answer. Also, if you do like this video, make sure to hit that like button for the YouTube algorithm, as well as subscribe so you don't miss out on future tax saving strategies. And if you're serious about using real estate to reduce your taxes, then you don't have to go it alone. Let our team help you shortcut the process, ensuring that you're maximizing your tax savings and minimizing audit risk by booking a free 30-minute discovery call by clicking the link in the description to this video. That's it for now, and I'll catch you on the next one.